Alright, so now let's do an example on the chart on how we can spot those natural or unnatural, or we can say artificial DXY correlation. In this example, we have DXY here and we have gold on the right, okay? So if we look at gold, we can see that from here to here, let's say this period of time, we have basically gold going down. We have a bearish movement, okay, which started the 11th of October until October 22. So basically 11 days, gold is bearish, pushing down, going down, okay? Not necessarily a smooth ride down, but slowly but surely we're going down. However, if we take the same period of time on the DXY, okay, so basically from about here, 11 October to the 22, yeah, somewhere about here, okay, what do we see? We see a DXY that is in a consolidation, okay? If we have a bearish gold going down, DXY should do the opposite. So we should have a bullish DXY pushing up. We should see a lot of USD strength in the market. But DXY tells us a different story, okay? We have a consolidation. We can even say that we are going slightly down, okay? Technically it's a consolidation, but we still see there's a tendency in the price action to push down, okay? So we have a problem, okay? We have gold going down, we have DXY in a consolidation going down as well. So this means this movement is artificial, okay? It's unnatural. Something is going on. If gold was really had the intention of really pushing down and continuing the movement, like I said, DXY would go up, would push up. The fact that it did not go up and push up means that the US dollar is being limited in its upside. So that means that gold is not bearish, it's on the contrary, it's going to be bullish. So this whole movement from here to here is just positioning, market placement, and the real intention, so the real intention is basically to be bullish, okay? Is to be bullish. So for example, as soon as we get here, for example, we had this large support here, okay, boom, instant reaction, big upside, big bullish reaction. If we look at the DXY the same period of time, you see this great reaction on the DXY, bearish. So USD is getting sold off. It is a sell-off on the USD at that same moment as gold is being bought. So this is a natural correlation. They are inverse to each other, and that means that the intentions are clear and that we're looking for a bullish gold. So that helps us to understand basically the current market trend, the current storyline, the current, let's say, market intention, and then from that it gives us extra information to then go and look for an entry point and to execute a long. Does it mean that the DXY is going to give us an entry point to enter into a trade? No, it just gives us extra information and gives us the intentions of the market. So if I see that the market is pushing down, and while it's pushing down, I see DXY not moving or slightly pushing down, I know that this movement is artificial, unnatural. So I'm not going to be looking to enter shorts because I know that the intentions, on the contrary, they're going to be long. So if I spotted this type of behavior before, maybe on this support, I would have, found a good technical point to enter into the long here, okay? Or maybe on the third, point here, which is basically when we get this reaction and when we get this big sell-off on the DXY as well, okay? So the whole goal of the DXY, like I said again and again, just so it's clear for everyone, it's to show the intention of the market. It's basically a great index, great tool to use when you're looking at commodities, indices, You can use it for Euro USD, GBP USD, currencies. You can use it for anything that is related to USD, and it's a great tool to give you those intentions. Okay, so now let's do another example where we have, let's say, a clean correlation. So let's say we go a bit further and we see, for example, these movements. So for example, this, of course, this if we go, let's go step by step actually. Let's go, if we're here at the beginning of this bullish movement, from here to here, we're basically pushing down on DXY. So this is correlated, great, okay? Then from here to here, we have a bullish reaction, but DXY is correlated, it's bearish, but the movement is very minimal. So for example, here you can also use the strength of the movement of the response on the DXY to understand also what's going on and have extra information. So if we take this first move and the second move, okay, the second move is slightly smaller than the first move. So let's say this is 1, this is 2, but it's about, I would say, 75%. Number 2 is about 75% of the length in terms of pips of the first one. But if we look at the DXY, the reaction, we see that the first sell-off, the number 1, is a lot bigger than the second one. So the second one is a bit more soft, okay? That could also, give us an idea that maybe the sell-off on the USD is getting, weaker and weaker. We can expect a retracement before, continuing on our way. And then here, if we get the third impulsion over here, and if we find the match on the DXY, let's get precise. So from this candle, it's about here. Yeah, it's basically this whole movement here, but there's something interesting about this part. Okay, so basically, number 3, same thing, pushing up, DXY pushing up, but with almost the same strength, the same variation in the gold in terms of pips as the same size variation in DXY. So the movements are proportional. And then we see the bull run slowly slowing down here. Movement is tapering down, and on the DXY we have basically the same thing. So starting to have a bit of a consolidation on gold, and we have a consolidation here on the DXY. So the movements are correlated. They are basically doing almost the same thing. In this case here, it's a consolidation, so they don't need to be inversely correlated, and it means that the movement is coming to an end, and we have a small retracement and so on and so forth. We can keep doing it and back testing it into the future, past, whatever we want on the chart. But I think you get the idea. So as you can see, it's very, very useful to detect those unnatural movements and see that the intention of the market is not going into that direction, and then you can start preparing yourself for the opposite reaction, okay? Just like the first example we did, okay, which was this part here with this part right over here, okay? And then when it's correlated, so when we're pushing up basically and the DXY is pushing down, and we are inverse to each other, it means that the true intentions of the market are clear. It's following the trend, and we can find good opportunities, good technical entries, and execute those ideas. Okay, we're gonna do a few more examples when we get to the other parts of the course, but this was just to give a general example on how to spot basically when we have a correlation that is natural and when we have a correlation that is artificial, and how to find the true market intentions.